Welcome back to International Finance. I am Andy Kim, your Dr. Finance. We are going through Chapter 7, and this part is about currency futures option. And currency futures option, these are the options on a currency futures contract. You know, the currency futures versus forward, right? Futures is much more standardized. Why? To be able to be traded among millions of different traders very frequently, in milliseconds, so that the price will be much more efficient over here. And then, so you can easily put the call option or put option or all kinds of exotic options based on this futures, 선물 option kind of things, okay? So exercise of a currency call futures options results in a long position. Okay, long futures position for the holder of a call or the writer of a put option, it said. But why long position? Because this is a right to buy it. Buying in futures market is taking a long position. You end up long position if you exercise it. Exercise of a currency put futures options, on the other hand, will result in a short futures position for the seller of a call or the buyer of a put. Okay, so put option is about the right to sell. Okay, right to sell. In futures market is about the short position. So you will end up in a short position. That's what we are trying to say. If the futures position is not offset prior to its expiration, foreign currency will change hands. Right? Now, binomial futures option pricing. Let's go through one example over here. A one period at the money call option on euro futures has a strike price of $1.53 per euro forward rate 1 year from now, right? Let's say this is a strike price as well in our contract, option contract, okay? And these numbers are coming from the previous video. And then 1.5, that's a spot rate. And then dollar rate, 1 plus. And then the euro rate, 1 plus, is over here. It's just a simple IRP, interest rate parity relation. And that's forward rate from now, right, 1 year from now. Now that turns out to be, let's say this is a strike price. That's all that I'm trying to say. And then that's here, you have that. And then 1 year from now, this forward rate, okay, may change it, right? Based on spot rate expectation, it could be $1.8 per euro or $1.2 per euro, upstate or downstate, depending on it. Well, you can figure out the forward rate at the end of 1 year, 1.836 or 1.224, okay, 1 year from now. So this, right, let's say we can say this as a futures price, right? The underlying asset price and strike price. This is higher than the strike price. You have a call option. You can exercise it. You will exercise it. The difference is the call option payoff, 30 cents or 30 cents and 60. Okay. On downstate, you will not exercise it because the underlying asset price is lower than the strike price. Make sense? Now, when a call futures option is exercised, the holder acquires a long position in the futures contract. Okay. You're buying that futures contract at the cheaper price, okay? And the cash amount equal to the excess of the futures price over the strike price. It's like a daily resettlement in the futures market going on, all right? Now, let's consider a replicating portfolio over here. Okay, replicating portfolio, replicate what? Well, we're going to create a risk-free asset. Okay, risk-free asset that gives me the same cash flow regardless of the states of nature. Upstate or downstate, we're going to have identical cash flow. Okay, and then this portfolio gives risk-free cash flow to me in the future, so I can safely discount it at risk-free rate to obtain the present value of the portfolio. And this portfolio, we will design it to hold a futures call option in this portfolio, either in long or short position, but this is a short position, right? So that we can back solve the call option value by figuring out the present value of this portfolio. Now, what's this portfolio? How is it structured? Let's say it's a long position on futures contract, long on underlying asset, short on something, the short on the call option. Okay, one futures call option. Longing how much? How many? H futures contract. Okay, so we're gonna figure out this one and that guy. Okay, now let's see. The strike price and then current price of futures is this guy, and then the future in the 1 year from now it may go up or down like this, and call option payoff will be over here 0.306, right? Why did I say minus over here? Because we will take a short position, okay, in call option, so that's why it's minus. And then futures payoff based on the H number of futures contract, that payoff will be 0.27. Where does that number come from? Well, that's the difference between this 1.8 and the 1.53. Okay, so every futures contract will give me 27 cents. So I just have H contracts, right? Unknown. Now portfolio of these, right, should be giving me this cash flow, 27 cents for futures contract, but I took the low or the short position on the call option. So at the end of 1 year in upstate, my cash flow will be, the portfolio cash flow will be like this. How about the cash flow in the downstate? Well, call option payoff will be 0. Futures payoff, right, it will be negative 33 cents times H. Why is that the case? Because that's this guy. Wait. So that's this guy minus 1.53, okay? 1.2 spot rate at the end of 1 year, right? Minus today's forward rate. That's 33 cents decrease, right? So that's why it says minus. How about the cash flow of the portfolio? That's minus H times 33 cents. That's aggregation of these two, right? Right. Now, what did I say? This portfolio, we design it to be risk-free so that we could discount it at risk-free rate, okay? So I want these two cash flows to be identical to each other. So equate these two, we have one unknown, H. We can solve for it. That's the right amount of futures contract, okay? The portfolio is riskless when the portfolio payoff in the upstate equals the payoff in the downstate, right? H turns out to be 0.51. Excuse me. Now, the payoffs of the portfolio are minus 0.1683 in both up and down state because we took the short position of call option, right? Short is minus. Now, this and that, you check the number, okay? Then what will be the option price today, right? Well, figure out the portfolio value today. Now you have the future value of your portfolio, risk-free portfolio that has a short position of call option. Remember that? H number of futures contract and shorted one call option, right? What do you do with this? Well, you got the future value, okay, risk-free. Get the present value of it by discounting it at the risk-free rate. And then you will get the present value of your portfolio. There you have long position of futures contract and short position of call options, right? Interesting thing is the futures contract, right? The long position is 0 because there's no cash flow at initiation. So it makes our life easy. Okay, so without an arbitrage, it must be the case that the call option income today is equal to the present value of 0.1683 discounted at risk-free rate 7.1%, which is 15 cents 72. Okay, This, right? Why is it positive number? In the previous slide, it was minus 16 cents 83 minus. But that, remember, is a short position result, right? Here at the beginning, you took a short position. You short sold this guy, which means you got the cash in front, up front. That's why. All right, my CD is just ringing somehow. Here's my, lecture. Good that you pay attention, CD. Good, CD. Anyway, so risk neutral valuation is the next one, right? Here in the previous slide, we went through a binomial pricing, chopstick looking one. But this chopstick looking one, right? You can do another one approach called risk neutral pricing, risk neutral valuation. Calculating the hedge ratio is vitally important if you are going to use options. The seller needs to know the hedge ratio if he wants to protect his profits or eliminate his downside risk. Okay. Remember, hedge ratio is making you risk-free in in upstate or downstate. The buyer needs to know the hedge ratio to decide how many options to buy. Knowing what hedge ratio isn't especially important if you are only trying to value options. Okay, if your purpose is only to value options, you can take another approach called risk neutral valuation. This is a very handy shortcut to valuation. Here, right, let's go through one example based on the previous numbers, right? We can assume that the interest rate parity holds, like $1.53 per euro. That's a 1 year forward rate based on spot rate today, and then the risk-free rate of two different countries, domestic versus foreign. And then euro versus US dollar, we are taking a US investor's perspective, right? Foreign currency, domestic currency. This is the asset that you want to value, right? With respect to US dollar, this is currency that you are using. And then that's today, okay, euro value. It can go up or down 1 year from now, 18 or 12,000, right? US dollars worth. Set the value of 10,000 euro, but forward at $1.53 per euro, equal to the expected value of the two possibilities shown above, right? Here we are trying to compute the risk neutral probability based on the two states of nature. Let's say this 1.53 futures, right? The forward rate over here, that's over here, right? 1 year from now, we are expecting it, okay? We are expecting the exchange rate, the spot exchange rate to be 1.53, okay, at this point. That should be the probability weighted average, okay? Remember, 1.53, remember this forward rate is our expected spot rate 1 year down the road. We are using that idea over here, okay? Bring this guy to 1 year from now, and we are interpreting this 1.53 as a probability weighted average of spot rate in the future. Okay, 1 year from now, right? 1.8, 1.2, weighted average of this guy, these two guys, should be none other than 1.53. We just don't know the probabilities of the two different states of nature. That's the idea over here, okay? And then 1.53 should be the weighted average of 1.8 or 1.2. Why isn't it 1.8? We are just multiplying by 10,000 euros over here, and then exchange rate. So that's why 18,000 and 12,000 over here. Probability Q and 1 minus Q, right? Why isn't it just P? It's just a convention of representing something called risk neutral probability. We went through that part in last week's lecture. So go ahead and watch that if you don't, if you're not clear about it. Now, solving for Q gives the risk neutral probability of an up move in the exchange rate. Okay. So if you do the math, do the arithmetic, solve for Q, it should be 0.55 or 11 over 20. Okay? Now what do we do with this? Well, write it. Okay? Write it. And then now we can value the call option at the present value, discounted at US dollar risk-free rate, because we are taking US investors' perspective, domestic currency US and foreign currency euro, and then we are valuing that call option. All the expected value of the option payoffs. Well, we have two different states of nature, two different call option value at the end over here, right? We have probabilities, okay, like this. So right, I should shut my mouth in 1 minute or something, right? And then calculate using the risk neutral probabilities. We can compute the weighted average of these two call option value at the end of year one, right? That's what's on this numerator side, okay, numerator. And then the denominator, what are we doing? We are discounting this expected value of call option at US risk-free rate, 7.1%, right? So numerator, again, this is the expected value of call option under the risk neutrality assumption, risk neutral world, right? We're creating that kind of risk neutral world so that we could discount that the risk-free rate. I told you before, why risk-free rate in risk neutral world? Because the risk premium, okay, risk premium has to be added to risk-free rate only when the investors are risk averse. If the investors in the market are risk neutral, which means investors are as happy as the exact amount of dollars they got, okay? $10 happiness is 10 times happier than $1 happiness, right? If that kind of investors are full in this market, right, then you are living in a risk neutral world. We are assuming this kind of bringing this whole discussion into this risk neutral world, risk neutral probability. We introduced it because it enables us to use risk-free rate as our discount rate to get it over here. And then the call option value is computed to be $1,540, right? Good. Now what? That's risk neutral pricing of the option, right? Over here. And then one interesting thing is there's a duality of calls and puts on currencies market. Duality? What is that about? We're going to talk about it in the next video. So thanks for watching until now, and then see you in the next discussion. Bye.